really from today's perspective, obviously there are lots of challenges globally, personally, and a lot of uncertainty. And I will not do a full service to all of those challenges, but I will endeavour to cover some of them and provide hopefully some insightful views. Ordinarily, I'm part of a large team, so if I don't have a strong view on one of your questions, I might defer, but I will come back in writing with a detailed answer should I think that's more appropriate. Really, from my perspective, as Robin said, Head of Investment Directors at Quilter Investors. Quilter Investors, for those of you who don't know, is part of Quilter PLC. So we recently rebranded to Quilter. We were previously Old Mutual Wealth and part of Old Mutual South Africa. But as we stand as a PLC today, we manage around 107.4 billion of investments on behalf of clients, and that covers over 900,000 clients. So a significant footprint. But equally, from my perspective and a corporate perspective, the importance, obviously, of the end customer and the relationship we have with you. But our relationships are via advice. So the relationship you will have with Robin, for example, is of paramount importance. And everything we do is trying to support advisors to support their end clients. And that's really the essence of what we are trying to do. From today's perspective, I will cover three topics. I will begin a bit of a scene set and a slight walk down memory lane, not Coronation Street, as somebody alluded to earlier, and just review markets over the last decade and some of the experiences that I guess most of us have had, whether we're running portfolios or from a personal wealth perspective. Then move on to consider what is an extraordinary year so far. And then lastly and latterly, we'll consider the outlook, consider some of the challenges, the drivers, but equally with a dose of reality. Now, moving on to a review of where we have been. This chart here shows in sterling terms what we've seen broadly over the last decade up until the end of 2017. So for almost a 10-year period, I show core asset classes in sterling. Obviously, there can be a reasonable differential, whether it's in local currency or sterling. Things like oil or gold, obviously priced ordinarily in dollars, so that there can be quite a significant deviation or adjustment based on currency. But basically, I've done it in sterling here because for most of you, I'm sure you're investing in sterling, you're sterling-based investors, and that's what's most relevant to you. Now, what jumps out at me here is that returns over that sort of 10 years since the financial crisis have been particularly strong. I think ordinarily, if you were to look at actuarial assumptions, regardless of the provider, you would expect to see from a 100% global equity portfolio annualized returns somewhere in a region 7 to 8%. Now, those returns don't come in a linear manner, so you can have particularly strong years and weaker years, but over time, 7 to 8% would be what you'd expect from a 100% global equity portfolio. And that can be seen when we look at these charts, although some regions have done slightly better. I think more interestingly, from my perspective, is when we look at some of the returns that we've seen from things like government bonds and global high yield. So we're probably on the back of a 30-year bull run within the fixed income arena. And some of the fixed income assets have done extraordinarily well, and I'll touch on this latter part today. But ordinarily, from things like government bonds, you are investing in a relatively secure asset, depending on the sovereign entity you're investing with, but it's almost a loan. So you are providing capital, and your expectation that over time you'll receive a coupon or interest. And as long as the government doesn't default, at the end of the period, you'll get the capital back. That's based on you holding them to maturity as opposed to selling them on. What we've actually seen is a huge surge in government debt and the price of that. And actually, we're now seeing globally quite a high proportion of government bonds offering investors what's referred to as a negative yield if you hold them to maturity. i.e. you will not get back the same amount that you invested if you hold into maturity, which is quite extraordinary, and I will pick that up in a second. Now, we look at 2018, and 2018 was probably a slight reminder for many of us that whilst we'd had quite a benign we had seen, we saw in 2018 what some research from Deutsche Bank said was one of, and at one point it was set to be, but one of the worst years on record. And by that, I mean by the most number of asset classes posting a negative return in that period. If we look at this chart, things like gold, for example, posted a positive return, but that was only due to the dollar sterling currency move, as opposed to the base asset posting a positive return in that period. And I think it was just a reminder, really, that in 2018, there were numerous geopolitical risks and uncertainties started to manifest themselves. We saw, obviously, the trade war start to ensue, and that really did unsettle markets. But actually, it was a reminder that we are later cycle, or we were later cycle, and that volatility, whilst we hadn't experienced it for the preceding years, is something normal within markets. And that can be, I guess, in two camps. You might perceive it as good or bad volatility. Good if it's volatility or different performance on the up, and slightly more negative on the down. But volatility does create that opportunity. But equally, what most investors saw in 2018, whilst it felt quite severe compared to recent experience, the volatility was still below average. So actually, it was a relatively benign year compared to traditional volatility that we'd seen in the past. Now, we step forward to 2019. And 2019, almost unanimously, was a good year for assets. Regardless of what asset you held, you should have made a positive return. Now, 2019, what were the drivers of that? I think we started to get some confidence. We saw trade phases being agreed between the US and China. And I guess ultimately, some of the risks that that spooked markets in 2018 hadn't necessarily dissipated entirely, but felt that they were more controllable, or in essence on the back burner. I think when we look at markets, there are always risks, and what you are doing is trying to ascertain what is the likelihood of those risks manifesting themselves. It's more of a probability. But then conversely, what you might do about that. There are always risks. You can never have a zero risk environment, but you're looking at the probability of those risks coming to fruition and what their impact might be on markets. What we did see in 2019 was a very strong run from technology, and I will pick that up in a second. Now, against that backdrop, whilst coming on to my previous point that we are or were later cycle, one of the points I always try to make, by being later cycle, that doesn't necessarily mean that we are going to have a cliff edge moment like the financial crisis, for example, or .com. But what it does mean that you could see a significant slowing in certain economies or markets, and that's normal, that's healthy. But 2020, as we could be forgiven to forget, actually we expected it to be a good year for risk assets. And one of the triggers also was that 2020 is an election year in the US. And historically, if you look over time, election years, almost without exception, there are one or two exceptions, but almost without exception, are strong years for the US and strong years for the US economy. For that reason, alongside other metrics, we expected 2020 to be a good year for risk assets. Now, I think we all sit here today. We jump forward. This chart shows returns in Q1. How wrong, I guess, were our expectations? Now, I think with the benefit of foresight, nobody would have expected a global pandemic. I don't expect for one moment, if we were to look back, any of us would have expected to be the majority of the developed world operating in some sort of lockdown regime and having to wear face masks when we enter shops or numerous other environments. Now, I have seen a video of Bill Gates back in 2015 when he spoke about the risks of a global pandemic. And again, there is always a risk of a pandemic, but maybe for all of us in our lifetime, hopefully this will be the only one. But obviously it's had a severe impact on markets, a severe impact on economies. And I guess whilst as we stand here today, we don't know when we will come out of this. Ultimately, we will come out of it. At that point, we will have a different environment. Now, this was an image that I released on an update that I sent out to sort of end clients and advisors. And really, one of the burning questions when we saw that sell-off between February and March, and the toughest period really was between sort of the 16th of March and the 23rd of March. And lots of questions I was getting was around, okay, at what point will this change? What will be the catalyst for markets to recover? Now, we'd obviously seen phase one towards the end of March. We'd seen the sort of stress selling and some drying up of liquidity. Now, liquidity wasn't necessarily poor within markets, but it was a buyer's market. If you were a forced seller of assets in the latter part of March, buyers in the market could offer you a significantly discounted price if you needed to raise capital. And that's what we mean by sort of stress selling. But what was significantly different around sort of the COVID-19 market environment, historically, when we've looked at things like financial crisis, Black Monday, the global financial crisis, intervention from central banks and policymakers could be that catalyst to get markets going again. Now, we'll come back to that in a second, but one of the key points that I was making was really that phase three wouldn't be dictated by intervention. You might be able to minimize some of the downside pressure by intervention, but the virus would dictate when we moved from phase two into phase three and phase three into phase four. And that's something that's quite different to the past. And for many people, people struggle to get their heads around it. There was nothing we could do necessarily from a market perspective. COVID was going to dictate that pace. Now, I'm sure most of us have been around for a decent period of time. I mean that with due respect to all of you. But if we look back over time, we've had numerous shocks within markets. This type of image is widely used. A couple of points I'd like to draw out. Remind ourselves that the scale on the left obviously adjusts over time. So when we look at periods like .com or the global financial crisis, the Lehman Brothers collapse in 2000 and 2009, the drop was actually far more severe than the drop we've seen from COVID. However, the scale is at a higher level now than it was. So just make sure we have that context there. I think when we look at this image, something also to bear in mind, I think when we look at other stress points within markets, there's been a period of months where we've moved from the prior peak to the trough as a result of that particular trigger point or event within markets. I look at 2008, 2009. There was a multiple month period as markets ebbed lower. That was significantly different with COVID. Markets ground to halt very quickly. Economies ground to halt very quickly. And it was a matter of weeks that we went from the peak, which was broadly on the 19th of February, to the trough, which broadly I would suggest is on the 23rd of March. Now, I'm sure Robin and his team worked really hard trying to assure you as investors that whilst at that moment in time, things could look quite painful, to not really have, and I don't want to necessarily use the term sort of knee-jerk, but sort of irrational or make decisions based purely on fear, which is naturally in market conditions. And I think in that scenario, you have to reassess, has the world changed forever, or is it a moment in time event that's impacting markets? And now I'll come back to this in a second, but if we look at where we were at the end of June, now markets have pushed on slightly more, we've almost retraced to the point we were pre the sell-off. I've come across investors and advisors that had made decisions during the sell-off and now look back with the benefit of hindsight and slightly regret that. But equally understandable sometimes when it's your own wealth and there is that concern. But I think that the thing we always have to remind ourselves that markets ebb higher, they ebb lower, but over time they trend higher. This chart really sort of shows the difference we've seen between quarter one and quarter two. So grey bars across multiple asset classes, again in sterling terms, show the severity of the drawdown we saw in quarter one. And then what we see for the same asset classes is the recovery that we've seen in quarter two. And without fail almost, apart from UK property, and from a UK property perspective, we're looking at commercial property. So I think maybe actually I might touch on that for a second. So UK commercial property, many property funds in the UK suspended, but whilst property funds in the UK have suspended previously in the past when it has tended to be around liquidity, this time was on the back of a new policy. So the guidance for property funds is if there was uncertainty in valuing 20% or more of their assets, that would mean that the underlying valuation of that property portfolio would lack some confidence or credibility. And that really was the situation. Given the number of businesses that stopped trading, ceased trading, couldn't operate, the uncertainty around much of that commercial property space was huge. And that was really the basis for many property funds suspending during that period. Now, as we come out of COVID, at the point we come out of COVID, I think there is definitely uncertainty around commercial, also both office and retail space in the property arena. And I think from our perspective as investment managers, we are signaling that we will redeem out of property assets throughout this year when right opportunity arises, because there is too much uncertainty. I think when we look at what has COVID forced the market to do, it's forced many businesses to show that they can operate remotely. So from a financial services or an investment perspective, or many offices, most people are operating from home very effectively. Now, what does that mean? That does mean that I think most people strive to have a better office home working environment. I'm hearing more sort of talk around 2 to 3 days in the office, 2 to 3 days working from home for those people that were previously 5 days in the office. Now, ultimately, what that does mean for many corporates is that they will need less office space. If you have a large element of your workforce on rotation, maybe hot desking, you could easily reduce your office space by 20, 30% or maybe more. For corporates that are spending tens of £1 million a year on office space, reducing that by 20, 30% has quite a significant impact on their balance sheet. So that's something to consider. But if we look at the rest of this chart, I think we've seen stellar returns. I look at the returns from many regions. We've been very strong. Even things like gold. Gold held up very well as a good diversifier in the sell-off in Q1. You can see the grey bar of 10.9% in Q1. And actually, it continued to post a positive return even in quarter two. And really, where we saw the stimulus from governments, there was a heightened concern around potential inflation within markets. And people continue to look for a hedge against that or a diversifier within their respective portfolios. We've continued to see the US do extraordinarily well in this space. But I mean, if I grab a separate piece of data, what's still quite surprising, and we'll touch on this later today, there's quite a dispersion in regions. So I think sometimes people can see headlines, and we'll see markets like the US, for example. The US has retraced all of the fall that we saw during February to March. And actually, if we look at the S&P, and I'll touch on this later, the S&P is up circa 12% year to date in sterling terms. However, we look at something like the FTSE 100, where there is, I guess, a difference in the economy. We look at the US, very tech heavy, very tech led, and we'll look at this later. The UK is more traditional in its makeup, less tech focus. The FTSE 100 is still down 20% year to date. So I guess it depends where your portfolio is positioned, but there equally is some opportunity. And really, another slide really backs up my story from earlier today. The importance of staying invested. You will obviously have a very thorough plan. Hello?
Danny, hi. Sorry
Robin.
it's Robin. Yeah, hi. Danny, before we go on to this next slide, can you please go back to the slide prior to the previous one, please? Where we had
This one.
yeah. Could
Yes.
you, someone has just asked, for the sake of the record, can you just explain what the three different lines represent? So the black line.
No problem at all.
Thank you.
It's in the disclaimer at the bottom, and very happy for any of you to have copies of these slides. They are complied for retail use, so feel free to look at these at your leisure. And if there are any further questions, do pass them through to Robin, and I'm very happy to answer them outside of today. But to be clear, the green line, hopefully nobody is colorblind, but the green line, so the highest line on the chart is the MSCI World Index. So for an MSCI World Index, that is ultimately the aggregate of global stock markets. The gray line is a Bank of America Global Corporate Bond Index. So green line, equities globally, gray line, bonds globally, black line is a Bank of America sterling overnight rate. So in effect, trying to give you a decent proxy for cash. So green, equities, gray, fixed income, black, cash.
Thank you, Danny.
No problem at all. So really just coming back to one of the points I always try to make, and I'm sure Robin has had this conversation with many of you, it's very important to stay focused on the plan that you've agreed. It's very important not to try to market time. Markets are particularly efficient. It's difficult to market time. Although as portfolio managers, we obviously strive to make adjustments within portfolios as we see fit. But to be very clear, we are investors, not traders. So we are completing a huge amount of work to position portfolios for what we expect to come both in the short and medium term, as well as long term, although not trying to second guess markets or currencies in very short periods of time. And really what this chart, very self-explanatory, it's well used within the industry. Even by missing a few days, you can have a very large impact in the success of your investment portfolio. So it really comes back to that chart we looked at a moment ago. Markets will ebb up and down over time. They will naturally trend higher. And the importance is to be invested within the market to participate in that. If you try to be too clever, I guess, and that can be from my perspective or an advisor's perspective or a client's perspective, it's very easy to miss a couple of days within those strong returns, and it has a material impact on your wider portfolio. Now, moving on to coronavirus, there's plenty of commentary within markets. So I don't propose to spend too much time, but ultimately the good news is that the increase in infection rates, in particular in the US, obviously there was a significant difference between regions. At what point did coronavirus cases start to spike? But what we are seeing is both the case count is starting to materially slow, and also hospital admissions are falling. And this is naturally having a positive impact, I guess, on the momentum in the wider economy. And we've seen, I'll come back to data in a second, some stronger data coming through, which looks at things like the Purchasing Managers Survey. Now that ultimately is a survey of supply chains across 19 industries. So starting to look at, is there a pickup? Is there a degree of consumption? Is there that sort of step change where we can start to see people coming back to work, we can start to see people spending again, which naturally is good for economies. Now, I think there's been lots of talk around the shape of the recovery, and I think there's multiple differences here when we look at recovery. Are we looking at markets? Are we looking at economies? And people have looked at different sort of acronyms, whether it be a V-shaped recovery, a U, a W, and more recently I've heard a K. And I think whilst I don't necessarily like any of them, the K partially resonates with me, because to say that we're going to see a V-shaped recovery, that markets and economies had a big sharp fall and then recovered, would be false. The K, and what does the K mean? Certain areas will participate in that recovery and certain areas will do well. But unfortunately, and I'm sure we're very aware of this, there will be areas that don't recover. There will be areas in the market that don't bounce back. And that's really where we sort of try to distinguish that it won't be a V shape for everybody. And potentially that's where we see that K. I think closer to home, we are seeing a beginning of a second wave, or arguably we're in the second wave. And ultimately this becomes a bit of a waiting game to see how far the offsetting lockdowns are going to go. But it seems that likely that they will become a lot more targeted. We are seeing that in the UK, and they will try to limit national lockdowns. That has been really prohibitive for the economy. The government will want economies to get back functioning as much as possible. They want schools to remain open, but I think we are going to see more targeted and more focused lockdowns, both nationally and across sectors. And I guess, the type of lockdown regimes we're experiencing at the moment are probably as the best we could hope for the remainder of the year. And I think, whilst always frustrating, I think if we can get ahead of this during 2020, that would be a better situation than having a material overhang into 2021. What we've also seen in Europe, we're seeing strong consumer spending, and I'll come back to consumer spending in a second, but there's a combination of pent-up demand. And actually, countries like China have returned to positive retail sales. So that really is positive, and something that I think we'll focus on. And I'll look at different ways in a second of what the type of data that we will focus upon. I'm actually going to flick through this slide in the interest of time. Now, I think at the forefront of our minds, moving into quarter three, there are lots of things that concern us. Coronavirus is at the forefront. Brexit, I think we have to remind ourselves, whilst Brexit is very material for all of us, personal reasons, personal interests, the UK economy, it's a very small element of the global stock market, somewhere between 6 to 7%, depending on how you measure that. So always have to remind ourselves when we look at our own investment portfolios and the opportunity, the UK is a relatively small market compared to the rest of the world. Now, if we look at data here, so this data is from the IMF, and whilst we've seen markets seem to bounce back relatively unscathed, arguably driven by the huge intervention, and there's a chart in a second that obviously will show some of this intervention. But if we look at the chart on the left, we've got a chart on the left which looks at sort of near-term, shorter-term growth expectations from the IMF, and on the right we've got slightly longer run data that looks at different scenarios as well. But ultimately, if we focus on the developed market or developed economies lines, and that's the orange line on the chart on the left, or the bottom line, even at the end of 2021, this line is still below the end of 2019 level. Now, remind ourselves where we were at the end of 2019, expectation year on year for the next 3 years, so 2020, 2021, 2022, that we were going to see positive growth from developed economies. We were going to see significant growth from emerging market economies. So whilst we have seen that sharp recovery, give ourselves some context that a lot of that growth has been sucked away. And what it does mean is that whilst we have seen that sharp recovery in markets, is it underpinned as strongly as we would hope by economies? I think we still need to see some data coming through, but it will make us focus a lot more on what we are paying for those that exposure. So really decomposing markets, really to understand what that picture is at a more granular level. If there's still headwinds with COVID, if there is still uncertainty from an economic perspective, are some of the valuations on companies that we're seeing globally justified, and I'll touch on that in a second. Now, this shows the tremendous amount of sort of both monetary and fiscal stimulus that we've seen globally. And if we look at the IMF data, for example, that's circa $10 trillion of stimulus, which ultimately is a staggering amount of intervention by central banks. And what we are hearing is they are prepared to do more if needed. And we've also seen more targeted designated measures to stimulate demand, such as the Eat Out to Help Out schemes in the UK. Now, there is still going to be concern, the number of people that are still put off from going out to dine, going back to work, the impact that that has on the infrastructure around cities. And in the medium term, we're going to see a significant dispersion in that space. We will continue to need to look very closely at the tone and the rhetoric, both from the US and the Bank of England. They're both due to speak either today or this week. And what we've seen from the Fed very recently, or the latest monetary policy meeting, they said that they are prepared to adjust some of their longer run goals. And from that perspective, really the policy strategy that we come out from Jackson Hole, they announced that they will move to a more flexible regime around inflation targeting. So actually start to look at, rather than an absolute threshold, more of an average. So really starting to see governments or central banks understand that we could see some inflation coming through, that could be a good thing from an economic perspective. So start to be slightly more tolerant of some of the data that we see coming through. And I don't think we necessarily at this point in time are going to see any more intervention from, I guess, the US or the UK, but we are definitely seeing that they are signposting that they are prepared to do more. Now, the challenge when we look at data, all this data will look pretty disastrous. When we look in an economic perspective, it's rearward looking. If the markets have been in lockdown, data will look quite poor. So it does then mean that maybe we'll need to look at data in different ways, or look at different cohorts of data to get an understanding of what is going on. Now, this is one example. So I'm sure many of us have used OpenTable, which is both a website and an app, looking at restaurant bookings. It really starts to give you an idea of what is the consumer doing, what is their behavior. So if I go back to that example I made earlier around sort of the K-shaped recovery, there's going to be a greater dispersion between winners and losers. Certain sectors will recover, certain sectors will be decimated. So it's pleasing when you start to look at data. This is for the US, for example, people starting to want to dine out again, make restaurant reservations. We can see similar increases in footfall when we look at travelers on the US or the New York Metro. I've got another piece of data in front of me here, for example, that comes out from Bank of America. Now, interestingly, it looks at daily spending by categories. So if I look at different categories, people making bookings with airlines year on year is down circa 90%. Lodging down 60%, entertainment down 87%. But then on the inverse, I think we're seeing a lot more discretionary spend around people doing work on their houses and property. People are at home, they spend more time in their property. We've actually seen quite an increase in discretionary spend on people's properties. Online electronics is up 150% year on year. Online retail is up 93% year on year. So I think what it does encourage us to do is to look at some different metrics when we're trying to understand what are people's behaviors. Are some of the interventions that we're seeing getting traction? But conversely, looking at data and really appreciating actually airline travel down 86% of bookings year on year, that's going to take a significant time to recover. Now, there might be opportunity there, but just really trying to look at different data to understand what's going on within economies. Now, from a US election perspective, a lot to happen here. I think we're still too early to make any calls. Biden is currently ahead in most polls, but he's probably overstated the margin. And I would suggest that the election will be closer than most would expect. I think ultimately the worst outcome is probably if the vote is too close to call. And there's also a degree of doubt around the robustness of postal voting. We've seen President Trump really play that card and try to unsettle people by signposting concern around postal voting. But neither Trump or a Biden victory is seen as particularly supportive for markets. So that's something that volatility we can see from both of those. And I think Trump hasn't got the fiscal headroom to offer more tax breaks that he offered coming into his former election. And he's also, I think, shown himself as being quite fickle on his reliance of Twitter use. So trade tensions ultimately would likely increase and continue. And I think it's really the US trying to stall what is inevitable of China becoming the world's most powerful economy. Biden would ultimately look to increase tax rates, and I think he has more of a traditional approach. I think when we look at from a Biden perspective, his approach to both geopolitics and national politics will be more traditional and arguably less supportive for markets, potentially increasing tax both on the wealthy and corporates, which could have impacts on both market levels, valuations, and the dollar. But I think as we go through this year, a lot of this is still at play. There'll be lots of adjustments within the polls. And I think whilst we might have perceptions around how both of these candidates might behave going forth, depending on the situation from COVID and the impact, that their hands might be slightly tied when we look at that. I think the concern from a trade war perspective, that is set to continue. The impact of companies like Huawei, TikTok will definitely mean it's not a smooth environment for risk assets. Not to say there's not opportunity, but I think we will continue to see that volatility. Now, moving closer to home, whilst a relatively small part of the global stock market, we've seen Johnson's plan to renege on part of the Brexit deal, which was passed at the first hurdle in Parliament, and actually had this passed at the first hurdle in Parliament on Monday. Now, it was a bruising debate. I think most of us would have seen that with senior members of his own party denouncing this move. The House of Commons passed this internal market bill in the first main vote by a comfortable 77 votes, allowing it to go through to the next stage. And ultimately, the Prime Minister said the proposal and legislation which will rewrite part of the withdrawal agreement is essential to maintain the UK's economic and political integrity. Now, Johnson's decision is ultimately to revisit this agreement. I would suggest potentially is the right thing to do. I think from his manifesto, he said he would take a hard stance with Brexit. I think what we will see is some quite strong challenge. I don't expect to see in the short term any agreement, but I think consensus and our view currently, although there's a lot of movement as we go through this, that we will see some sort of 11th hour agreement on Brexit. It doesn't necessarily feel there's anyone's best interest to have a no deal, but I would guess maybe slightly less traditional, but brinkmanship, winning negotiation. Boris Johnson is playing a tough hand as we stand today. Now, in the short term, that does mean that sterling has been under pressure. So from a market perspective, that does have a different impact, whether we're looking at more domestically focused companies or if we're looking at sort of the FTSE 100, for example, where a lot of their earnings might come from overseas and they will benefit from that repatriation of earnings back into sterling. So it shouldn't be perceived as entirely bad for the UK stock market. It will differ dramatically between companies and the shape of their business and their dependency on where their earnings come from. Now, slightly mindful of time, I will push through the next couple of slides quite quickly. So where does that lead us? I think going back to the earlier charts I've shown you, we've seen a significant outperformance, in particular from the US. And I think if we look at where we stand today, the last couple of years, any sort of sensible diversification in a portfolio has not necessarily been the right thing if you're looking for out and out performance, although diversification is a good thing from dealing with some volatility within the portfolio. Now, what we see the chart on the left is the US versus the rest of the world ex-US. Now, we can see significant outperformance of the US since the financial crisis back in 2008, 2009. And ultimately, part of this has been driven by technology names, which we show on the right. The US is a tech-heavy economy. Now, I think there are two things to question as we come out of COVID. As I said, we will come out of this one day. We don't necessarily know where. But really, from a portfolio perspective, we have to ask ourselves, these companies have been the disruptors and also the beneficiaries. As a result of COVID, though, they could continue to benefit. They could be in that sweet spot. However, is this priced into their valuation? So some of these companies have done extraordinarily well. Their valuations are particularly high. Are you being rewarded for taking on some of that risk, in particular with that large mega cap, large cap tech names? There could be companies below the surface that offer decent returns in technology space, but actually that might mean moving away from some of the companies referred to as FANGs, Facebook, Apple, Netflix, Google, etc. Now, one thing to signal, maybe it is a change in regime. Now, this is quite different from the US compared to the UK, which isn't particularly strong with tech. It's more of a traditional makeup from a market perspective. These technology companies are very different to they were during .com. So back in .com, a lot of these technology companies were in their infancy, where these companies now are hugely profitable. They have been disruptors, and they've got a tremendous amount of growth on their capital on their balance sheet, and we're seeing significant growth. The question will be, can they continue to really pull that rabbit out of the hat? Expectations, valuation levels are quite stretched, and does that give some concern that there's little room for them to disappoint? There's little room for them to give softer forward guidance. So I'm not for 1 minute saying that we should completely shy away from these companies, but actually these companies have driven the majority of the US stock market in recent time. And I think the pressure on them going forwards is a lot more difficult. So I think really from running a portfolio perspective, diversification going forwards, I think will have more of a place. I think we've been in a slightly artificial environment for the last couple of years when most returns have come via a very small cohort of companies. And as we can see here, for example, these technology companies, 5 stocks now account for, and the figures updated since then, it is over 22% of the entire US market cap. I looked with much interest at the Apple announcement last night. I'm quite an Apple fan personally, but remind ourselves that Apple at the trough on the 23rd of March, their market cap was around $1 trillion. Their market cap as we stand today is in excess of $2 trillion. Their market cap is greater than every company in the FTSE 100 put together. So tremendous companies, huge admiration for them. There are some questions around how stretched the valuations are. And I'm really trying to bring this to some sort of end and conclusion. I think from our perspective, we are more cognizant that there are uncertainties in markets going forwards. There is probably less wriggle room for some of these companies that have got strong valuations. We saw Tesla's share price, for example, down 11% over a couple of trading periods week before last. I think we are going to be a lot more sensitive to, one, which regions do we want to have exposure to, but what are we actually paying to gain that exposure? What room for error is there if there are some bumps in the road, if there are some negative headlines, if corporates have to signal that they have some softer forward guidance? So again, I think really a more balanced and rounded portfolio is definitely where we would favor, and being very mindful of some of those stretch valuations. Now, again, we can look at a chart like this, and this would signal at current level, the US in its entirety is expensive, but that can be skewed by certain sectors or certain pockets. If we were to take out technology, for example, out of that first column, the US wouldn't look expensive. So I guess ultimately coming back to that analogy of the K, I do think it's going to be more of a stock pickers market where there are going to be some significant winners and significant losers. I think all of us, regardless of our financial knowledge could look down a list of companies and have a view on whether these companies are going to recover coming out of COVID or not. Now, really coming back to maybe a dose of reality, and I'm quite a positive person, I don't want to be too negative, but really looking at this chart, I think what this chart really shows is two things. It shows over the last decade for a plethora of asset classes what we've seen on an annualized basis returns versus what we are seeing from actuaries going forth. Now, I haven't cherry picked an actuary here. Whether I look at companies like Moody's, Towers Watson, I look at assumptions coming out of people like JP Morgan, Goldman Sachs, the consensus is that returns going forwards will be somewhere in the region of half or less than what we've experienced over the last decade. Okay, now what do I mean by that? Well, if you take the headline index level, that's the expectation. So as investors, what do we do? What do you do? There are two challenges here. Returns from equities will be lower and returns from fixed income will be significantly lower. We won't have that 30-year bull run. So do people increase risk to make up for that shortfall? I suggest it will come back to doing something slightly different. Now, as a house within Quilter Investors, we run both active and passive and blended strategies. I think going forwards, our expectation is that returns coming from straightforward headline indices, if we say the FTSE 100 or the S&P or the DAX, could be slightly more muted, but you're going to see a greater divergence beneath the surface between companies and corporates. And that's really where I suggest we need to do something different. Either we resign ourselves to the fact that returns will be lower. Now, that might be completely the right thing for you as an investor and be comfortable with that. Although if we want to try to achieve returns anywhere near what we've seen over the last decade, I do think it's going to be an environment where you need to do things differently and potentially different to what we've seen over the last couple of years. It could be a good year, a good period for active managers. And when we start to look at the behavior year to date, we're starting to see some really strong managers from our perspective deliver significant returns. Now, from my perspective, we are not experts in every single company globally, but what we think we're very good at is find good managers globally to run various elements of our portfolios and make that fund selection and asset allocation decisions potentially on your behalf. So really, I think a couple of sort of final points to leave ourselves with. I think markets have recovered well. We are probably at a bit of an inflection point. We are going to enter phase 2 of COVID. Potentially we'll see a third phase. There are lots of reasons to be positive. We've seen earnings seasons come through. Lots of companies have posted very good earnings results. There are lots of companies that have done well during lockdown, but conversely, that is not all. I think from an economic perspective, we do need to start to see that continued improvement of economic data coming through. That's all return to work, companies starting to operate with a heightened degree of normality. And I guess ultimately from the consumer, although unfortunately there'll be a tremendous amount of people that either within their own businesses or from an employment perspective are in a tougher place, to start to see people spending again. And hopefully that coming through will be more supportive of markets. As I touched on, returns are likely to be lower going forward than we've seen over the last decade. That shouldn't be necessarily a reason to be negative, but I think the two things I want to land there is that we've had a particularly strong last decade. Returns are there to be had. They will become pretty tougher to come by. And I think we are going to see heightened volatility going forwards. But actually, volatility is normal. I think it's been slightly suppressed in recent times, and volatility shouldn't be feared either by you as investors or equally as us as investors, potentially with your wealth. But ultimately, there are lots of risks there as we stand today. The job that we have to do, spend a lot of time engaging with managers, doing our own analysis, looking at the probability of what we can see. Obviously, there's limited visibility in certain space, and try to look at the probability of those coming through. I think as we stand today, well, we are favouring equities, and we do think there is opportunity out there. We are being mindful of our risk assets within the portfolios, mindful of what we're paying for that. But I think we've probably got one of our higher weightings to active managers where we want them to be particularly agile on our behalf. That's probably it from me. Apologies, I think I've overrun, but hopefully there was some useful content there.
Danny, thank you so much. Yeah, you have, but it went really quickly for me. I don't know about everybody else. I've got a couple of questions. One from the floor, one from myself. So we talk about returns possibly being lower over the long term. How does that compare in relation to interest rates? Because obviously, the reason people tend to take risk is to deliver returns over and above interest rates. So what's your expectation of long-term interest rates?
And this should have been something I looked at last night. And when I thought I'd do a bit of analysis, I decided not to bother. My expectation, long-term interest rates, that they're going nowhere fast. There is more limited scope for central banks to move down. I think when we look back, even back to the end of 2019, the expectation from the Fed was for a continued trajectory of rates ebbing higher, and the UK to follow suit, although at a slightly slower pace. But actually the new norm at the end of 2019, let's say in the UK, was probably going to be over the next 5 to 10 years, somewhere in the region of 3 to 4%. That was pre-COVID. Okay, so we're looking at a level there, probably half of where it'd been previously, pre-COVID. I haven't seen any research or any expectation that rates are going to ebb higher from any materiality for any significant period of time from this point forth. So I think your point there, rates are going to be disappointing. I think returns that, I'm not saying from a fixed income perspective there aren't returns to be had, but I think some of the returns that people have become accustomed to from both government bonds and corporate bonds in recent times will be leaner. So that does then ultimately, I guess, I touched on earlier, we are later cycle where we come into end of cycle at the end of 2019. Arguably, COVID could have, you could say, there's sort of reset that cycle, reset that process. So I think really where clients can tolerate risk, it would definitely favour risk assets and in particular equities.
Yeah, thanks. And then I've got a couple of other questions that have come from the floor. One of them is that on your summary, the actuaries have foreseen perhaps lower returns. Do you think that's based on them thinking that COVID or the effects of COVID will go on longer, or are they just looking at where they are at the minute? So we feel we're in a second phase. Are they basing in perhaps a third phase of COVID, a third peak?
I mean, when you tend to look at most of the actuarial assumptions, they are based on particularly long-run data, both historically and forward-looking guidance around growth expectations, rate expectations, forex expectations. Now, they tend to release data on a quarterly basis, so there was a reasonable adjustment. But I mean, we're talking basis points, not percentage points here. So basis points, I mean a decimal place of a percentage here. Adjustment at the end of March data. End of June hasn't seen a material adjustment since March. However, even if I step back a year, forward-looking return expectations were significantly lower a year ago compared to what we experienced over the last decade. So I would suggest that COVID, whilst will have had an impact on sectors, won't have really changed those headline returns significantly. The shape might be slightly different. So again, if you look at what do you expect from global stock markets, what do you expect from emerging markets, there might be an adjustment between regions or sectors or cap size, but the actual end answer hasn't changed dramatically.
Okay, thank you, Dan. And then I think finally, unless I get some more questions, but of course the floor can always ask me questions afterwards, and I can put them to you if I may, Danny.
Indeed.
Something that's on everyone's mind, although I know it's not an asset class that you've covered, because when we come to investing, other than our homes or buy-to-lets, we don't tend to look at residential property in as an asset class in investing terms. But have you any opinion on residential markets, whether that might be in London or in the provinces?
Um, it's not an area of expertise other than personal interest. I guess like there's been lots of coverage around the record number of people looking to leave central London or to leave or aspiring to have more space, let's say. So I think for a lot of people that were living in large developments, which ordinarily would look fantastic. You are in the centre of London or a centre of Manchester in a high-rise apartment. But if that's where you are stuck, I think it has focused people's mind about the importance of outdoor space, etc. I think from a personal view, there's been lots of talk around, I guess, a lot at the sort of first time buyer, second time buyer end, talking to sort of people doing conveyancing, etc. Obviously, a lot of people want to do property moves by March. So I think it depends where you sit. I think that stamp duty break will have a natural impact on a certain area of the market. Are there an increased number of people looking to move out of cities? There are. I mean, I drove from London at the weekend and drove out to Guildford and looked at a few properties, and obviously that was a debate that we were having previously. Equally, I know a couple of friends that have sold properties in central London within 2 weeks, put them in the market over the last month. So I think that demand's still there, and I think I read quite a detailed article from a property valuer in the US, and I think on the back of 9/11, there was lots of expectation that nobody would want to live in high rises, people want to live in central Manhattan. And then you wound forward a few years and property prices were at all-time highs. And not say people had forgotten 9/11, but that perception of, do we want to live in high rises, do we want to live in a city, had definitely dissipated. So I think in the short term, there might be a heightened number of people looking for more outdoor space or potentially moving out of London. I think when you look at some of the data coming out from CBRE, etc., I think going forwards, I wouldn't see a material impact on property prices. And actually, I think month on month, we've started to see a bit of an increase in property prices. But it's going to differ to a degree depending on size of property, exact location. Could there be some pressure on these very large developments of high-rise properties? Potentially. But equally, properties that have got some outdoor space, I think will fare slightly better. So I'm not seeing anything material in the property space outside of short term. And I think what people tend to do is over time, their initial sort of fears or concerns tend to dissipate. That's probably a long answer.